Hey everyone, and welcome back to another video for today. Can you believe it? We are already 50% done with 2025. We're in the month of June, so let's talk about the 4 best stocks to buy in the month of June. Again, when I say 4 best stocks, it's not always the best stock for you or your portfolio or your investment style. Okay, very important to note. Those are 4 good companies, quality companies that I think are worth looking into, and that's what we're going to do in this video. There's also going to be one company that a viewer suggested to look into, pretty interesting one. So let's jump right into that. These are the 4 companies. I hope you keep watching. If not, leave me a like and a comment. And if you're new here, subscribe. We're trying to reach 100,000 subscribers, so thank you very much for all the support. And of course, if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And also a special thanks to FinChat for sponsoring this video. You know FinChat, it's already here on the screen. So first company I want to touch on is Salesforce. Salesforce just reported earnings also Wednesday after the market closed. Stock was down on Thursday, was down close to 6%, but closed out the day at down 3.3%. Now I'm filming this before the market opens on Friday. There has been some movement before the market opens, so don't be surprised if the numbers that you're seeing right now are a bit different. Now, Salesforce is a company worth $255 billion, a PE, well, trailing 12 months PE 43.2 times, and a forward one of 23.7 times. Now, as you can see, over the past 5 years, the stock is only up, I say only, 51.2%. So yeah, there are plenty of other stocks that of course have outperformed Salesforce, and I do even think that the market outperformed Salesforce over the past 5 years. But this is the thing, you're not investing in the Salesforce of the past, you're investing in the Salesforce of the future. And if we want to look at what the market expects from Salesforce in the future, we can use here FinChat, a stock research platform that you've been seeing on this channel for quite a while. So let's say we want to look at the upcoming fiscal years. What's the expectations for revenue growth? We can do that right here. And we can see that the market expects revenue growth to reaccelerate, although still not double-digit growth. Over the last 12 months, that's 8%, expected to be 8.6%. Then in fiscal 27, should jump to 9. And then we should be fiscal 28 closer to 10%. Now, what about free cash flows? Well, we can do the exact same thing. We look at what the market is expecting. 11.6% year-over-year growth is what has happened over the past 12 months. Then for the fiscal year 26, sits at 8.2%, the expectations. Then we expect it to accelerate to 13.2% year-over-year growth in fiscal 27, and then another 12.5% year-over-year growth in fiscal 28 to reach $17.12 billion in free cash flow for a period of a year. Now, of course, you can look at everything else that Salesforce does. Where do they generate their revenue from? How do they generate it? We're going to look at that, of course, in this video, but all of that is available for you on FinChat. New users will get 2 weeks of FinChat Pro for free. And if you love it, you can use my link. You'll get 15% off. Thank you very much. Now, since Salesforce did report this week, we've got some fresh numbers. So they told us that data, cloud, and AI annual recurring revenue is over $1 billion. That's up more than 120% year over year. Nearly 60% of Q1 top 100 deals included data center, cloud, and AI. Salesforce has closed over 8,000 deals since launching Agentforce, of which half are paid. Now, they also announced, well, before the earnings, there was an announcement that they're going to acquire a company for $8 billion called Informatica. Now, as we know, Salesforce is well known for their acquisitions, the acquisition of Tableau, of Slack, for example. So they have already spent billions of dollars in acquisitions. And as you know, the markets usually, when a company does say that they're going to acquire another company, well, the acquirer is going down, their stock is going down, and the company that gets acquired is going up. Now, in this case, I think $8 billion for Informatica, sounds big. And of course, we still don't know how well the integration will be, remains to be seen. Plus, the impact of that deal will only be seen in fiscal 27. So the market is also like, okay, this is going to take a while to actually see what the impact will be on the overall business. Now, what benefit is this for Salesforce? One, data integration, so unified actionable customer data for Customer 360 and Data Cloud reliable, compliant, and trustworthy data for AI when you look at data quality and governance, master data management, so golden records for accurate sales and service, transparency and compliance for regulated industry, and then foundation for agentic AI and autonomous business agents. The thing here with SaaS, which has now become, of course, just AI, is that you had so many products, so many solutions, maybe different silos as well, and you couldn't really get a clear view of everything that's, well, happening. This should change it. Now, as for the quarter they just reported, this was basically it. So pretty good quarter all in all. Full year guidance for some of it that was raised as well. Revenue, subscription and support revenue that was raised. GAAP diluted EPS and non-GAAP were raised as well. For Q2, they expect revenue to grow around 8 to 9% year over year. And this is basically the trajectory of Salesforce over the past couple of years. And yes, as you can see, this is not a high growth company anymore, but this is a stable growing company that is, of course, very profitable. And if we actually look at remaining performance obligations, that has accelerated over the past 2 quarters, which I'll take as a big positive. Now, margins-wise, this company has become definitely better. Gross profit margin have increased over the past 5 years from 74.9% to 77.3%. Free cash flow margin went from 18.8% to now 38.8%, and that's again over the last 12-month period. So Salesforce, although has underperformed over the last 5 years, I do think that it is a very good company at an attractive price today. Moving on to company number 2, and that's the Clorox company. And that's a company that, well, a viewer actually mentioned during a live stream. So make sure you tune into those live streams. So the Clorox company manufactures and markets consumer and professional products worldwide. It operates through 4 segments: health and wellness, household, lifestyle, and international. And now here as well, as you can see, this has definitely underperformed over the past 5 years. It's actually down 35.9%. Has a market cap of $16.1 billion. PE is low, but again, these types of companies usually don't get a super high PE. Revenue growth expectations are basically flat for the coming fiscal years. Margins are getting better and better. And that's basically what I want to talk about this company. Right now, the trading PE sits at 23.5 times compared to the average here since 2017 of close to 55 times. If we look at the forward one, also much lower than the average at 18.9 times. Looking at forward price to free cash flow, we're at 22.3 times compared to the 8-year mean of 27 times. Now, here, if we look at net income, what has happened, right? Why have we been previously closer to $1 billion, $900 million or so for a year? And then we, well, basically got cut in half, although more recently we have seen it go up quite nicely. So maybe we are in a recovery phase. Well, here are a couple of explanations. One, normalization of COVID-19 driven demand for cleaning products, significant increases in commodity, manufacturing, and logistics costs. There was a cyber attack as well in August of 2023, caused major disruptions to order processing, production, and product availability, leading to decreased sales and incurred recovery costs. There was also divestiture of vitamins, minerals, and supplements, VMS business. So that's out of the way. And so now that that's out of the way, we are, of course, seeing growth yet again. And if we look at revenue over the past couple of years, as you can see, very slow growth, right? Compound annual growth rate 2.2%. But margins have, of course, come down for the reasons that I've just mentioned. But as you see, gross profit margin each and every quarter now have become better and better. And free cash flow is also making its way back up to double digits. As I said, they generate revenue through different segments. So health and wellness, household revenue, lifestyle revenue, and international revenue, with the last one being the smallest and the first one here being the largest. Now, as you can see, there are 2 segments that have underperformed over the past couple of years. Household revenue did decrease by 19% since June quarter of 2022, and international revenue did also decrease by around 10.4%. Health and wellness did increase by 10.3%, and lifestyle revenue by 4.79%. Now, I know this might not be the sexy company out there, but here you have maybe a company that, by the way, it's also paying a dividend, 3.6%. It's a company where its stock has underperformed for the right reasons over the past 5 years, But over the past couple of quarters, we have seen signs of it recovering, especially when it comes to margins. And if margins continue to go up, well, it's only a matter of time until we actually see revenue start to reaccelerate as well. And if you get revenue reacceleration plus margins, whether it's gross profit or free cash flow margin, continue to go up, well, then you have a perfect mix. Again, it's not a company for everyone's portfolio. It is, of course, boring compared to a Salesforce or compared to a New Holdings, which we're going to talk about right now. So, New Holdings, as you can see, over the past 5 years has underperformed the market, but you had plenty of time to buy over the past 3 years. I mean, if you look at that performance, the stock is up over 200%. It has a market cap of $57.8 billion, trailing PE 27 times, forward one 21 times, price earnings to growth ratio of just 1. Here, this is, of course, compared to Clorox and even Salesforce. This is a company that is still expected to grow quite rapidly for the years to come, and we're back under $12. And with New, there's always that one slide during the earnings presentation that always blows my mind, and this is it. Their growth over the past 11 years or so. I mean, customers is now at 118.6 million. That's up 19.3 million year over year. Active customers, 98.7 million, up 16.1 million year over year. This is just incredible growth. Revenue has grown by 40% year over year on an FX neutral basis to $3.2 billion. If you look at the number of customers over the past 5 years, that has grown at a compound annual growth rate of 36%. Monthly active customers has grown at close to 45%, and the customer activity rate is still quite high, over 80%. So the more customers they'll attract, and if the customer activity rate stays the same, the better, of course, it will be for them. Looking at, well, revenue for each and every quarter, gross profit, net income, adjusted net income, still everything looks fine. Of course, margins. Margins is what everybody's been looking at. Margins have been declining as they continue to grow aggressively in other markets that are less established than Brazil. Brazil is their more mature market. They've explained that time and time again. But despite it being their mature market, as I'll show you in a bit, the opportunity there is still very big. Now, if we look at the delinquency ratio here, Brazil only, 15 to 90 days NLPs, it went up quarter over quarter, but lower than the historical seasonal 70 basis points. As for the 90 plus one, usually sits at 0 basis points difference, but this time we did go down. Now, if we look at NIM or net interest margin, here you can clearly see where they take a hit. Okay, it's the 1.1% hit from Mexico and Colombia. For Brazil, they're still doing fine. If we look at the other, let's call it net interest margin here as a percent. I mean, yes, okay, it's true that over the last couple of quarters, it has come down, right? You see that line right here. It has come down, but again, they're growing in their other markets, Mexico and Colombia. And as an investor, especially for the long run, if you look at their historical performance, they've done very, very well. So why should I doubt them today, although I'm not a shareholder of New anymore? Why should I doubt them today and say, oh, margins are coming down, they're growing in other markets, that's not going to work out well? I don't know. I think it will work out. And if you look at the opportunity for Mexico, the purple box in those big gray ones is New's gross profit market share in Mexico. So the opportunity is huge. And even in Brazil, the mature market for them, here as well, the opportunity is still immense. Now, yes, of course, there's not just New, there's also Mercado Pago from Mercado Libre that is going to be a big winner in those markets. But as long as New can continue to grow rapidly, expand, stay as profitable as they are, I mean, the more customers that they can attract, and if this stays the same, cost to serve per active customer, well, then they'll do very well in the long-term future. This is expected to be one of the biggest companies in Latin America over the next decade plus. Moving on to the last one, and it might be a controversial one if you truly believe that Waymo and Tesla are going to take 90+% of the future, well, transportation market, then of course Uber is a zero. But if you're on the other side of that, well, debate, then Uber is not going to be a zero. This week, Uber is down 4 to 5% or so because yes, Tesla is going to launch their small robotaxi demo network in Austin. Now, what's interesting to me is that remember that last year we've had the same thing happen. Late last year, we've had, of course, the stock pull back quite a lot because of the same thing, right? Because of the same reason Waymo and Tesla are going to destroy Uber. Well, what has happened so far in 2025 is that Uber stock has outperformed the market and actually outperformed Google and Tesla as well. It's up 31.5%. Not only that, the business has been performing extremely well. Uber is a company worth $176 billion, trailing PE 15.6 times, forward one 30.7 times, so here's the opposite, and price to free cash flow forward one 15.2 times. Now, last quarter, you might remember that for the first time since COVID, gross bookings did decrease quarter over quarter, but that's because of the strong dollar that reduced reported growth by about 4.5 percentage points in Q1. Now, as for the segment, mobility segment, delivery and freight, this is basically what has happened over the past couple of years. And for the quarter specifically, mobility revenue increased 15.3% year over year, delivery 17.5%, and freight is actually down 1.9%. But you can clearly see that over the past couple of years, this is a business that has grown quite nicely. It's also a business that is becoming more and more profitable. They also have investment in companies that you might have interest in: Aurora, Grab, Joby Aviation, and Serve Robotics. Looking at total trips does continue to increase a little bit quarter after quarter. That increased 18% year over year. If we look at the forward PE, 29.3 times. In this case here, on average, it was much higher because, well, the E was not really that great a couple of years ago. As for free cash flow, since the quarter where they basically flipped from negative to positive, free cash flow has grown at a compound annual growth rate of 143.4%. Beautiful, beautiful chart to look at. You can clearly see also that free cash flow margin continues to go up and up and up. Gross profit margin is coming down a little bit, although it has been stabilizing for the last 2-3 years or so. And remember, 2 quarters ago, they showed us this slide. Uber is well positioned as AV tech advances with several partners added already. And this is basically it. Uber is going to be that partner. Uber is going to be that platform where all of these companies might not be Tesla. Okay, might not be Tesla, might not be Zoox or Mobileye. But as long as you get the large majority of the players, you'll do just fine and maybe even better than fine. Uber has announced plenty of deals over the past couple of weeks, whether it's in the United States, in Europe, in the Middle East. It is a company that is definitely not standing still. There's also a business inside of Uber that is growing quite rapidly and has high margins, and at the advertising side of things, Uber's ad business surpassed $1.5 billion annual run rate. That's up 60% year over year, with strong growth in both delivery and mobility. On the AV side of things, they now have 18 AV partners globally and launch successful AV services in Austin with Waymo. They're going to launch with Waymo in other cities as well. And they're expanding to more cities and partners, including Volkswagen and Pony AI. The company is seeing very high utilization of Waymo vehicles in Austin, with the average Waymo being busier than 99% of Austin drivers. They've also expanding into retail categories and recently acquired Trendyol Go in Turkey for $700 million. And of course, the beauty of a business that is becoming more and more profitable and does generate billions of dollars in free cash flow is that when the stock was cheap at the start of the year, they just bought way more of it. They can, of course, invest in more companies because they are so profitable. And so while Uber might have taken a hit this week, it's still performing very well year to date. Like I said, I will be adding if it goes back into the 70s, mid to low 70s is when I'll start increasing my position yet again. So that's about it for this video. If you enjoy this type of videos, hit all the buttons. We really appreciate that, especially the subscribe one. Go try out FinChat down in the description and in the pinned comment, and I see you all in the next one. Bye-bye.